Welcome to this lecture on the relationship between interest rates and economic activity, where we'll unpack how rates shape spending, saving, investment, and market behavior. Over the next slides, I'll walk you through transmission channels, household and corporate responses, market impacts, and practical takeaways you can use to anticipate macro turns and inform decisions. This slide shows the transmission mechanism of monetary policy. A shift in the federal funds rate ripples through interbank, deposit, loan, and bond markets, altering money supply, credit availability, and asset prices. Consumers and firms often feel the effects within weeks, while the full GDP impact can take around a year as spending and investment adjust. Here we compare the household impact of lower versus higher rates. When rates fall, monthly payments drop, and cash is freed up for durables, travel, or renovations. When rates rise, households tighten budgets and cut discretionary spending first, which is why housing, autos, and big-ticket purchases are often the early channels for demand slowdown. This diagram highlights how deposit yields influence saving and spending. Rising yields attract savers and raise the opportunity cost of consumption and risk-taking, while falling yields push savers toward equities and housing, creating a wealth effect that can spill back into consumer spending and support broader demand. Credit costs shape corporate decisions. Cheap credit lowers hurdle rates and encourages new plants, tech upgrades, and hiring, driving expansion, whereas expensive financing freezes marginal projects, compresses valuations, and feeds earnings slowdowns, creating a clear trade-off between growth incentives and cost of capital in corporate planning. Interest rate cycles also affect inventories and supply chains. High rates create a contractionary loop where firms anticipate weaker demand, trim inventories, and delay contracts, amplifying downturns, while low rates trigger a recovery loop of restocking and upstream order, rebounds that accelerate cross-sector recovery and momentum. On equity markets, higher rates raise discount factors and lower forward earnings, which tends to push equity prices down. Growth stocks with distant cash flows suffer most, while financials may benefit from wider lending margins, driving sector rotation that investors need to recognize as rates shift. When policy rates rise, new issues carry richer coupons and existing long-duration bonds fall in price, yet stronger growth can improve credit metrics and enable conditional rallies in high-yield corporates, creating portfolio complications as rising rates and growth dynamics pull different assets in opposite directions. Policymakers face a balancing act under the dual mandate. Raising rates is the tool to curb inflation when unemployment is low, but risks slowing growth, while lowering rates stimulates slack and recovery when inflation is below target. So central banks must weigh trade-offs between price stability and full employment in forward-looking decisions. Clear central bank communication matters. Guiding future rate paths reduces uncertainty and volatility. Credible inflation targets anchor long yields, and data-dependent flexibility preserves room to respond to shocks without derailing activity. So credibility and messaging are essential tools for stabilizing expectations and market behavior. Strategically, watch policy rates as an early cycle indicator and incorporate forecasting factors like consumer elasticity, sector duration exposure, and corporate balance sheet sensitivity into your models. Align investment horizons to transmission lags so you can either exploit or hedge rate-driven swings across sectors and timeframes. To wrap up, remember the key takeaways. Interest rates steer capital flows and valuations, so mastering the mechanical links gives you an edge to anticipate macro turns, allocate capital smarter, and engage policy debates, and evidence-based analysis helps you navigate economic shifts with greater confidence.